Most people begin trading with the belief that better entries will solve their problems. They think one cleaner setup, one sharper confirmation, one stronger signal will finally remove uncertainty. At first, that belief feels reasonable because technical knowledge creates the impression of control. A chart looks measurable. A system looks objective. But after enough time in front of the screen, a quieter truth appears. The real difficulty begins after the entry, when price moves slightly against position, when the body tightens, when breathing changes, when the mind starts negotiating with itself. That moment has very little to do with market structure and almost everything to do with how much internal pressure a person can hold without reacting. A trader often believes the mistake happened in analysis, but many losses are created long before the order is placed. They begin in the nervous system. A position that is too large creates a level of emotional noise that distorts perception. A person who was calm before entering suddenly sees danger in every candle. A small pullback feels larger than it is because the body interprets financial uncertainty as threat. The mind then tries to escape discomfort by doing something immediate. Closing too early feels like relief. Adding to the trade feels like control. Moving a stop feels like self-protection. None of these actions come from clarity. They come from a body trying to reduce tension. This is why two people can use the same strategy and produce opposite outcomes. The method may be identical, but the internal response is not. One person can sit through ordinary fluctuation because risk is small enough to remain mentally available. Another person cannot because the amount at risk exceeds emotional capacity. The market then becomes less about price and more about self-exposure. It reveals how quickly someone abandons structure when discomfort arrives. Many traders misunderstand fear. They treat fear as weakness and try to eliminate it. In reality, fear often becomes useful when it is understood correctly. A stable trader does not remove fear. A stable trader listens to it carefully enough to separate signal from noise. Sometimes fear is simply the body reacting to uncertainty. Sometimes it is pointing to size that should never have been taken. Sometimes it is warning that the trade does not match the plan, and conviction is borrowed rather than earned. The important skill is not suppressing the feeling but identifying what produced it. There is a quiet difference between a person who wants profit and a person who wants stability. The first often enters the day already attached to outcome. Every movement becomes personal because money has been assigned emotional meaning before the market even opens. The second enters knowing that nothing important must happen today. That shift changes everything. If nothing must happen, there is less force behind each decision. If there is less force, perception becomes cleaner. A clean mind notices more than an urgent mind. Losses become destructive when they damage identity. A trader who secretly needs each trade to confirm intelligence cannot lose normally. A small red result immediately becomes evidence of personal failure. Then the next decision is contaminated. Instead of seeing the next setup clearly, they are trying to repair emotion. They enter too quickly, size too aggressively, or avoid valid opportunities because the previous loss is still active inside them. The account suffers, but the deeper damage is psychological because trust in self becomes unstable. Professional development often begins when a trader stops asking how to win more and starts asking why pressure changes behavior. That question leads to a more honest kind of work. It leads to reviewing not only entries and exits, but also physical reactions. What happened in the body before the mistake? What thought appeared before the impulsive click? What internal sentence justified breaking the rule? Over time, patterns become visible. Impulses are rarely random. They arrive with familiar emotional signatures. A common one appears after several losses in a row. The mind becomes impatient and starts searching for one trade that will restore emotional balance. The trader may call it confidence, but underneath it is discomfort with being temporarily ineffective. Another pattern appears after a strong win. The body relaxes too much, caution fades, and position size quietly expands because success creates the illusion that current perception is unusually accurate. Both states look different on the surface, but come from the same place. Regulation has been replaced by emotional momentum. The market does not reward emotional momentum for long. It eventually places the trader in front of uncertainty again, and whatever has not been understood returns. This is why many people repeat the same year of trading several times without real development. Time passes, but inner patterns remain unchanged. Charts change, market conditions change. The person reacts in familiar ways because internal habits were never examined carefully enough. A calmer approach begins with smaller exposure than the ego prefers. Small size feels unimpressive, which is exactly why many avoid it. There is little excitement in a position that does not meaningfully disturb the body. But that is where useful observation becomes possible. When pressure is low, the trader can actually see thought forming in real time. Hesitation becomes visible. Greed becomes visible. The urge to interfere becomes visible. That visibility is more valuable than temporary profit because it creates conditions for repeatable behavior. A stable trader eventually understands that survival is not passive. It is an active discipline. Protecting capital is not fear in the negative sense. It is respect for the fact that clarity disappears quickly when damage becomes too large. A deep loss does more than reduce numbers. It changes posture, mood, patience, and attention. Recovering from that takes longer than most admit. The strongest traders often look unremarkable during ordinary sessions. They are not searching for stimulation. They are not forcing identity through activity. They are waiting until internal and external conditions align enough to act without strain. This waiting feels difficult early in development because silence is uncomfortable when someone still equates activity with seriousness. What usually changes a trader is not a dramatic breakthrough, but repeated contact with ordinary restraint. There are days when nothing clean appears and the mind starts inventing reasons to participate. A candle moves sharply and the body immediately creates a story around it. It feels urgent because uncertainty mixed with desire often creates artificial importance. The disciplined response is rarely impressive. It is often just a pause long enough to notice that the urge came before the evidence. That pause protects more capital than many strategies. A person often believes discipline means forcing behavior through willpower, but that approach fails under stress because force collapses when fatigue arrives. A more durable form of discipline comes from reducing the amount of internal conflict before the session begins. If the trader already accepts that some days will end flat, some trades will fail, and some opportunities will be missed, then less emotional negotiation is required during live conditions. Acceptance lowers friction. Lower friction improves execution. This is why routine matters more than people expect. A stable routine is not superstition. It gives the nervous system familiarity before uncertainty begins. Waking at the same time, reviewing levels without rushing, checking exposure limits before the first order, and knowing in advance what conditions justify inactivity all create psychological order. The market itself offers none, so the trader must provide it internally. Without that internal order, random movement quickly pulls attention outward and decisions become reactive. Many people think confidence comes from winning streaks. In practice, that kind of confidence is fragile because it depends on outcome. One unexpected loss and the emotional state changes immediately. Real confidence develops differently. It appears when a person sees themselves follow process, even when the result is disappointing. A clean loss strengthens identity more than an impulsive win because one confirms self-trust, while the other often reinforces unstable habits. There is a quiet moment after a disciplined stop where a developing trader feels disappointment but remains intact. That moment matters because it teaches the body that discomfort can pass without repair through revenge. The account may be slightly lower, but psychological structure remains unbroken. This is how resilience forms. Not through large victories, but through repeated proof that temporary pain does not require immediate compensation. Many mistakes happen because people trade while carrying unprocessed emotional residue from outside the market. Fatigue, frustration, lack of sleep, tension from personal life, even subtle disappointment can all alter risk perception. The chart then becomes a place where unresolved emotion looks for movement. A person enters not because the trade is clear, but because action offers temporary escape from whatever feels unsettled internally. This is difficult to admit, because the mind prefers technical explanations. Yet many poor sessions begin before the platform opens. A useful question before entering any trade is simple. If this position fails exactly as planned, will I remain mentally stable enough to take the next one without distortion? If the answer is uncertain, size is already too large or emotional condition is already compromised. Small enough exposure preserves sequence thinking. Sequence thinking matters because no single trade carries meaning by itself. It only belongs to a larger series. The trader who forgets this starts assigning too much emotional value to one result. This is also why chasing recovery is dangerous. A person loses, then immediately feels pressure to restore the number because the loss now represents more than money. It represents discomfort, interruption, and wounded control. The next trade is no longer evaluated cleanly. It becomes a psychological tool. Once trading becomes emotional repair, perception narrows. The body searches only for immediate relief, and that urgency removes patience. Patience is often misunderstood as passive waiting, but real patience is active emotional regulation during uncertainty. It is remaining available without needing resolution too quickly. It means watching price move near an area without forcing interpretation because silence feels uncomfortable. Most unnecessary trades are attempts to escape unfinished moments. Over time, a trader notices that emotional intensity and decision quality often move in opposite directions. The stronger the need to act, the less likely the action is clean. Calm entries usually feel almost ordinary. They do not come with dramatic certainty. They come with enough alignment between plan, price, and internal state that execution feels simple rather than charged. There is also an important shift when a trader stops measuring days by profit alone. A day with no trades can be a strong day if conditions were poor and restraint was maintained. A small red day can be a strong day if losses were contained and no emotional escalation followed. This changes the internal scoreboard. Instead of asking whether money was made, the trader asks whether stability was preserved. That shift matters because identity follows repeated criteria. If self-respect only appears on green days, psychology remains fragile. If self-respect appears when process holds under pressure, then emotional dependence on outcome weakens. That makes the next session lighter because less personal weight is carried into each decision. The market eventually teaches that consistency is less dramatic than expected. It does not feel like certainty. It feels like reduced internal noise. The trader still experiences doubt, but doubt no longer controls action. Fear still appears, but fear no longer dictates size changes or impulsive exits. Loss still happens, but loss no longer enters identity the way it once did. This is why smaller size remains valuable even after skill improves. Many increase exposure too quickly because they assume technical improvement automatically means emotional readiness. Often, it does not. A larger position introduces new physiological pressure, and old patterns can return under stronger intensity. A person who looked disciplined at one level may become reactive again when numbers grow. Growth must therefore happen slowly enough that the nervous system adapts without losing clarity. The most reliable professionals often protect their mental state before protecting profit because they understand profit depends on state. Once the mind becomes crowded, opportunities become harder to judge correctly. Preserving calm is not softness. It is operational discipline. A clear mind sees what an agitated mind invents. A trader becomes more mature when they stop trying to remove uncertainty and begin learning how to function inside it without distortion. Early in development, there is often a hidden expectation that enough study will eventually create a state where every decision feels clear. That state never fully arrives. Even strong setups contain incomplete information. Even disciplined entries can fail immediately. The difference later is not that uncertainty disappears. It is that the trader no longer treats uncertainty as a threat that must be defeated before acting. This changes the relationship with hesitation. In the beginning, hesitation often produces frustration because it is interpreted as weakness, but hesitation can also be useful information. Sometimes it appears because the setup is incomplete. Sometimes because recent losses are still affecting trust. Sometimes because size is slightly beyond what the body accepts, even if the plan looks valid. A regulated trader learns to ask what hesitation means before overriding it. Not every hesitation should be obeyed, but none should be ignored without examination. The same applies to confidence. Confidence is often praised without asking what kind it is. Outcome-based confidence feels powerful but unstable. It rises quickly after a series of wins and usually carries subtle impatience. Process-based confidence is quieter. It does not need immediate proof. It remains even after a loss because it comes from repeated evidence that one can act cleanly under mixed conditions. This quieter confidence often looks less impressive from outside because it does not seek expression through larger size or increased frequency. Many traders damage themselves during periods when nothing obvious is wrong. They are not panicking, not revenge trading, not making dramatic mistakes. Instead, they slowly drift. A few extra trades each day. Slightly looser criteria. Stops adjusted by small amounts that feel harmless. This drift is dangerous because it rarely feels emotional enough to trigger alarm. Yet over time it weakens standards until the account reflects behavior that no longer matches original discipline. That is why review matters even when results look acceptable. The purpose of review is not only to study losses, it is to notice where standards quietly changed. A profitable day can still contain unstable behavior. A losing day can still contain strong execution. Without review, the mind remembers outcomes more strongly than process, and this creates false learning. Someone may repeat poor behavior because it happened to work once. Someone may abandon good behavior because one clean trade failed. The market repeatedly tests whether the trader can separate single events from long sequences. A single loss says little. A single win says little. Yet the mind constantly tries to turn isolated events into conclusions. After 2 losses, it starts questioning everything. After 3 wins, it starts imagining acceleration. This emotional interpretation creates unnecessary movement inside the person. Stable development requires staying close to evidence instead of mood. There is also a quieter emotional challenge that many do not expect. Improvement can feel strangely uncomfortable because stability removes intensity. Some traders unconsciously miss the emotional charge that came with impulsive behavior. Large swings in profit and loss created drama, and drama can become familiar. When trading becomes calmer, sessions may feel uneventful. The ego sometimes interprets that calm as lack of progress because there is less emotional stimulation. In reality, that calm often signals healthier functioning. A mature trader accepts that boredom is often part of correct behavior. Waiting is repetitive. Small losses are repetitive. Partial exits are repetitive. Journaling similar emotional notes for months can feel repetitive. But repetition is where nervous system adaptation happens. The body slowly learns that not every movement requires reaction. This learning cannot be rushed because emotional conditioning changes through exposure, not insight alone. One of the clearest signs of progress appears when a trader experiences a losing day without internal collapse. The disappointment is there, but it does not spread into self-judgment. The person closes the platform, records what happened, and leaves the day where it belongs. This sounds simple, yet it often takes years because many people carry losses far beyond the session. They replay them during rest, during conversation, even the next morning. By then, the loss has grown psychologically larger than its numerical size. Reducing that carryover is essential because tomorrow requires a clean mind. The next session should not become a continuation of emotional residue. This is why many professionals value stopping early after signs of internal instability. They understand that one more trade taken in the wrong state rarely damages only one day. It often affects the following session through lingering frustration or forced recovery. The market does not ask for emotional perfection. It asks for enough awareness to notice when clarity is fading. Sometimes the strongest decision is not taking another setup, even if one appears technically valid, because the internal condition needed for proper execution is no longer present. This restraint protects future decisions as much as current capital. Eventually, a deeper understanding forms. The account grows slowly, not because the trader found extraordinary opportunity, but because fewer emotionally expensive mistakes survive. Large errors become rare. Impulsive size becomes rare. Chasing becomes rare. The improvement is quiet, and therefore often underestimated. This also changes how success feels. Early success creates excitement because it seems to confirm potential. Later success often feels almost neutral because it belongs to a larger process. Satisfaction remains, but it does not disturb internal balance. The trader knows one good session changes nothing important by itself, just as one difficult session changes nothing if process remains intact. At this stage, the work becomes less about becoming impressive and more about remaining available. Available enough to observe clearly. Available enough to accept loss without contraction. Available enough to wait without forcing meaning into movement. That availability is difficult to notice from outside, but inside it changes every decision. A person who once entered the market needing proof gradually becomes someone who enters only when conditions justify participation. The emotional difference between those two states explains more than most indicators ever will. The final stage of trading maturity is often quieter than people imagine. There is no dramatic feeling of mastery, no permanent confidence, no sense that uncertainty has been conquered. What changes instead is the relationship with ordinary difficulty. The trader still sees loss, still feels hesitation, still experiences days where nothing aligns, but these moments no longer create identity disruption. They are absorbed as part of the work, rather than interpreted as evidence that something is broken. This matters because many people remain trapped in emotional oscillation long after they understand technical structure. They know where entries should occur, where invalidation belongs, what conditions usually support continuation. Yet under pressure, they continue acting against what they already know. The missing element is rarely more information. It is the ability to remain internally steady enough to let known principles survive live conditions. That steadiness depends on something simple but difficult. The trader must stop expecting the market to provide emotional reward. As long as a green day is unconsciously expected to create relief, self-respect, or reassurance, each session carries hidden pressure. Pressure changes behavior long before it becomes visible. It shortens patience. It narrows interpretation. It makes neutral movement feel personally important. A healthier approach begins when the day is allowed to remain emotionally unfinished. A trade may close in profit without creating excitement. A loss may close without creating urgency. A missed move may remain missed without immediate self-criticism. This emotional neutrality is not detachment in the cold sense. It is stability strong enough that external fluctuation does not immediately reorganize inner state. Many traders discover that the hardest moments are not the obvious losses, but the subtle ones. A valid setup appears just after they stopped for the day. Price moves exactly as planned without them. Or they exit correctly and watch the market continue much further. These moments can quietly destabilize discipline because they create the illusion that restraint caused deprivation. If not understood carefully, the next day becomes vulnerable to forcing entries in order to avoid repeating that emotional discomfort. This is why discipline must include acceptance of incomplete participation. No one captures all movement. No one exits perfectly across long sequences. The attempt to remove this reality usually leads to overtrading because the mind starts chasing completeness in an environment that never offers it. A mature trader accepts that many correct decisions will still feel imperfect in the moment. There is also an important shift in how effort is understood. Early on, effort often means watching more, studying longer, reacting faster, trying harder to control outcome. Later, effort becomes more selective. It means protecting sleep before active sessions. It means reducing exposure when emotional clarity is lower than usual. It means ending the day when concentration begins to thin, rather than waiting for obvious mistakes. The effort is still real, but it is directed toward preserving function rather than forcing result. The nervous system always remains part of trading, whether acknowledged or not. A person under internal strain reads the same chart differently than a person who is rested and emotionally settled. This is why consistency cannot be built only from external rules. Rules matter, but state determines whether rules remain available under pressure. A tired mind can justify almost anything if enough discomfort appears. Over time, the trader learns that the strongest sessions often feel almost ordinary. The entry was clear enough, the size appropriate, the exit respected, and no additional meaning was attached. Nothing dramatic happened internally. This lack of drama used to feel disappointing because earlier stages associated intensity with importance. Later it becomes evidence that behavior and capacity are finally aligned. That alignment also changes recovery after difficult periods. A losing week no longer produces immediate strategy changes unless evidence truly supports it. The trader first checks whether execution remains stable. Were losses normal within plan, or did emotional distortion appear? If process remained intact, then the week is simply part of distribution. This prevents unnecessary system switching, which often comes from discomfort rather than objective review. The need to constantly improve also becomes more grounded. Improvement no longer means searching for something entirely new. It often means removing one remaining source of unnecessary friction. A slightly earlier stop when attention drops, a smaller first position when returning after losses, a stricter refusal to trade when mentally preoccupied. Small refinements create larger long-term effects than dramatic reinventions. Eventually, the trader understands that professional behavior is repetitive by design. The same protections appear every week because the same human vulnerabilities remain possible every week. Ego does not disappear permanently. Fear does not disappear permanently. Impulse does not disappear permanently. Stability comes from respecting this instead of pretending growth has removed it. What the market ultimately teaches is not certainty but proportion. A single trade receives less emotional weight. A single day receives less narrative. A difficult month does not automatically threaten identity. Progress becomes visible through reduced exaggeration in both directions. Wins are not proof of superiority. Losses are not proof of failure. They are information moving through a stable structure. That stable structure is built slowly. Small size when ego wanted speed. Pauses when impulse wanted action. Ending sessions when fatigue wanted one more chance. Returning the next day without carrying unnecessary psychological residue. These actions look minor from outside, yet together they form the kind of trader who no longer needs intensity to feel engaged. At that point, trading becomes less about proving something and more about protecting the ability to think clearly under uncertain conditions. Profit still matters, but it is approached as consequence rather than emotional target. The person who survives long enough to understand this usually notices that the strongest edge was never hidden inside the chart. It was hidden inside the ability to remain unchanged while the chart kept moving.